Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Kansas City and Minneapolis wheat markets.
Kansas City wheat. Now, once again, and actually for quite a while now, prices have been hitting and utilizing the bright red trend line formed of the neckline of the small but influential October 2021 to January 2022 head and shoulders top, currently 847. You can see that even today as it has capped today's market. Now, as I said repeatedly, the market has occasionally staged rallies up to the 50% Fibonacci line of the August 2020 to May 2021 move at 900. But these rallies have stalled, and the market has instead expanded the downside, such that I said last week that there was an argument to look at the action since December 2022 as a possible expanding wedge pattern with a flat upper trend line. Though this week and last week I have not been wholly convinced of it, which is why I have not outlined it, nor marked it on any daily chart, not yet at least. What has been interesting in the increasing declines is that April constructed a monthly key reversal down, and that May very nearly did the same, but instead chose to have a lesser outside month instead. These moves down and then back up have set up a possible diamond pattern type for the action from April, May, and as we entered into June. I repeat for a second week, I am really not happy about this pattern type, but for the moment it might be useful. So I've outlined it in bright green on my daily chart. The reason why is that we seem today to have broken up and out of this pattern type. Hence I'll repeat once again my thoughts on such a break higher. Bearing in mind it is not confirmed as yet, but then it's a pretty big move higher, so I'll give it some leeway. Thus an initial primary target would be in the 902 area, just over the 50% Fibonacci line, with a further, harder to reach secondary target up in the 946 level. Now, we have a lot of resistances in the way before 900. One we already know about is the red neckline. We also have the 2014 high at 856, the 2013 high at 862, the flatlining long moving average currently at 870, and the 50% Fibonacci line of the September 2019 to May 2022 move at 881 before we reach the 900 resistance. Meanwhile, below the market, we have the flatlining medium moving average, currently 833, and the slowly descending short medium moving average, currently 824, before we even re-enter the diamond pattern type. Now, I've given limited supports below compared to above, and there's a reason for that. You see, the big move upwards today has set up the parameters for a possible weekly key reversal this week. Thus, if we close tonight either over 808 or under 793, then we'd be on. Right now, we are looking at a weekly key reversal up. Yeah, we still are. We're looking at a weekly key reversal up, which would tie in with so many other things. Minneapolis wheat. Compared to Chicago wheat and Kansas City wheat, Minneapolis wheat here continues to be an easier read with respect to what is going on and what the opportunities might be. In late January this year, prices punched up and out of the upper bear channel line of the first bear channel constructed between October 2022 and March this year. Then 14 weeks ago, we had the first piece of bearish pressure coming from how the medium moving average, currently 857, capped the market in mid-February with a subsequent move lower. There was then some hesitation, which eventually became a bear flag over the turn of February into March. It was at this time that the market constructed a second bear channel that after a period of time morphed into what we have now, a descending, expanding wedge pattern currently at 734 to 876, originating from December last year, but really becoming evident from February this year. This is highlighted in dark blue on my daily chart. The upper trend line, currently at 885, had been previously reinforced, sort of, by the declining medium moving average, which combined to help cap the market in very early April, then mid-April and mid-May. This week, we are seeing another fresh move higher through the short medium moving average, currently 835, and the medium moving average, and up as far as the August 2022 low at 862. All this is well and good, and at this moment does not counter the idea of the original bear channel, descending expanding wedge pattern, not yet. However, as I stated last week, and I quote, "The only other feature is a potential, and just that, a potential double bottom, formed since April. It's way too early on that as anything more than an idea," end of quote. It is still early, but I can set out some idea of when this potential pattern could become a real thing. And that would be what prices do should they get to the 890 area level. That will be where to look out for signs of this truly being a possible double bottom pattern. I'd add one further point to this. Look closely also at the now flatlining long moving average that is just above, currently at 898. I am sure this moving average will play a key part in any move up to the 890 area.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.